Okay, let's unpack this. Moving your own money domestically is basically a text message.
Right, instant and painless.
Yeah, but moving that exact same money internationally
Yeah.
is like, well, routing a physical letter through 5 different foreign post offices. Today, we are jumping into a stack of sources, specifically a really fascinating guide on cross-border rail friction, to understand the $150 trillion bottleneck of global money movement.
It is a massive issue.
Totally. Our mission for this deep dive: figure out why international transfers are so incredibly painful for you and businesses alike, and how next-gen tech is finally fixing it.
And, the reason it feels like passing a physical envelope across borders is because each postal service operates on totally different business hours.
Oh, right.
They use completely different messaging standards, and of course, they take a little slice of your cash just for handing off the envelope.
Well, to really appreciate the fix, we probably need to look at the legacy trap first. The correspondent banking model.
Right. Because a local bank in Ohio doesn't have a direct relationship with a regional bank in Japan, they rely on middlemen holding Nostro and Vostro accounts.
Wait, Nostro and Vostro.
Yeah, banks hold foreign currency accounts with each other to settle debts. Nostro means our money with you, Vostro means your money with us. It is basically pre-funded liquidity.
Okay.
But if two banks do not have reciprocal accounts, the money does this messy multi-hop route through larger money center banks that actually do.
So if Ohio Manufacturing pays $100,000 to Kyoto Robotics, that local Ohio bank has to, tap a big New York bank.
Exactly.
And New York takes a $25 fee, passes it to a Tokyo mega bank, who then skims a conversion fee. Maybe 4 days later, it hits Kyoto Bank. I mean, it sounds like a giant game of financial telephone, except everyone takes a cut along the way.
What's fascinating here is the downstream nightmare this creates. Because of those hidden intermediary deductions, Kyoto Robotics gets less cash than they actually billed for.
Oh, man, that's just like a headache.
It is. It forces companies into agonizing manual accounting reconciliations. Treasurers end up playing detective, making international phone calls just to find the missing money.
I am guessing we can't just unplug the global banking system. There has to be some sort of software band-aid holding this together for now.
Spot on. The industry patched this with an upgrade layer over the old network called Swift GP.
Swift GP, okay.
Yeah, it adds a UETR, which is a 36-character unique transaction reference number attached right to the payment.
Here's where it gets really interesting. So they basically just invented a FedEx tracking code for corporate money.
That is the exact mechanism. Let's say Global Tech Corp in Chicago sends $500,000 to Frankfurt.
Okay.
With Swift GPay, the treasurer watches it live. At 10:01 a.m., it leaves. At 10:03 a.m., it clears an intermediary bank, logging a $15 fee. By 10:06 a.m., it hits Germany. 6 minutes instead of 4 days.
But wait, a tracking number doesn't just make brains move faster. Why did the speed jump so drastically?
Because the tracking creates unavoidable accountability. Under strict new SLAs, member banks are legally bound to process funds immediately.
Ah, gotcha.
Yeah, that UETR code proves exactly whose desk the money is stalled on. They just can't hide the delays anymore.
Okay, forcing middlemen to be accountable is a great band-aid. But if I'm sending money, I want zero middlemen.
And that brings us to the actual cure: emerging multi-currency corridors. Countries are hardwiring their domestic real-time payment networks directly to each other.
Wow, okay.
Yeah, think of Singapore's Pay Now connecting directly to India's UPI system. They rely on atomic settlement, or payment versus payment.
Meaning the currencies swap simultaneously. How does that work without the risk that the other side just bails?
By cryptographically locking the transaction, the two currencies swap at the exact same millisecond.
That is wild.
Right. If one side fails, the entire transaction fails. There is zero counterparty risk, meaning they do not need intermediaries holding funds in escrow to guarantee everything.
So what does this all mean? For you trying to send money abroad, you aren't waiting until banks open in New York on Monday.
Exactly. Take Ananya in Singapore. On a Sunday night, she wants to send 500 Singapore dollars to her mom in India.
Okay.
She types in her mom's number, sees the exact exchange rate, and a tiny 50-cent fee right up front. She hits send, and it's there instantly.
Instantly.
Yep. If we connect this to the bigger picture, we are witnessing the dawn of continuous 247 global finance. We are transitioning from opaque credit routing to transparent, instant account-to-account settlement.
It fundamentally changes the friction of doing business globally.
Yeah, and this raises an important question. If cross-border money can soon move instantly and virtually free, how will that totally redefine global gig work and borderless digital businesses tomorrow?
It's wild to think about. Pretty soon, sending a paycheck halfway across the world won't be this grueling physical letter process. It'll just be a text message.